In recent months, I've been watching a fair bit of YouTube videos on finance and investments, and I've learned a few pointers from this group of young YouTubers. However, there seems to be a common trend among this group of young YouTubers. There is a strong focus on the sniper theory, all in into one stock. About 10x by 2030, about attaining FIRE, financial independence, retire early. Basically, a very strong common focus with regards to growing our wealth fast and retiring young on one sniper stocks. While I fully appreciate that there are many investment approaches, given the different risk profiles, investment objectives, and personalities, etc., I do believe that there are some common universal investment principles that will do ourselves some good if we were to give it some due attention, and will certainly go some ways in saving us some investment heartaches. To keep my video concise, I shall just focus on three such investment guiding principles. The first guiding principle I would share is invest only your spare cash. And here I meant truly your spare cash. And this should not be money for your next housing upgrade, your renovation, or your wedding expenses in 3 years' time. This should be money that you do not need for the next 10, 15 years, potentially money for your child's university education or for your own personal semi-retirement or retirement years. Over the long term, the market should give us decent compounded rate of returns that beats the inflation plus potentially a few percentage points to reward us for the risk of investment. However, over the short term, the overall market, let alone individual shares, can potentially drop 30%, 50%, even 90%. So unless these are truly your spare cash that you do not require for at least 10 years, under such market conditions, you will likely lose sleep over your investments and potentially may be forced to liquidate, losing a large chunk of your principal amount. In addition, if you have any credit card debts incurring interest of 18 to 24%, then I would suggest to you that you do not have true spare cash. Before you even consider any investment, I would suggest the first thing you should do is to pay down your credit card debts. There is no investment that gives you a guaranteed risk-free return of 18 to 24%. And paying down your credit card debts is equivalent to earning a guaranteed return of 18 to 24%. Similarly, for those of us who has an outstanding housing loan, the interest rate for housing loan has in recent months moved to 4+%, and in the coming months potentially moving up into the 5+% range. It is not easy to get a risk-free guaranteed return of 4 to 5% from the investment market. Hence, I would suggest for those of us who still have an outstanding housing loan to consider using your spare cash to first pay down your outstanding housing loan instead of exploring investment of your spare cash. The final point I want to make on the first guiding principle of investing only your spare cash is to focus on the word your. Thus far, I've been focusing on the word spare. The next point focuses on the word your spare cash. Regardless of our conviction, how strong it might be, how much we might believe in our theory, I would suggest that we should have some humility to accept that the market may at times prove us wrong. Regardless of how convinced we might be, I would suggest that we should never invite our parents, our parent-in-laws, our siblings to join us in that one investment that we have a strong conviction in. Every individual has a different risk appetite, different investment objective, different investment timeline, and certainly different personality. And things can get very problematic when the market turns against us in situations where we have invited our parents, our in-laws, our siblings to join us in that one investment that we may have a very strong conviction in. When the market is favorable, when the price of the share that you have recommended is going up, everything is fine. However, when the market turns against us adversely, you will be under tremendous stress. Financially, can they afford the financial loss? And more importantly, even if they can afford the financial loss, emotionally, can they handle it? And this is likely to then put a strain on the family relationship. The second guiding principle that I would like to share here is always invest in a diversified portfolio. The price movements of individual shares are influenced by a multitude of complex variable factors and risks. And this can include economic risks, political risks, natural disasters like the pandemic, SARS, and so on. Regardless of how strong our conviction might be, I think it will do us good to have the humility to accept that we can still be wrong. Individual share prices can shoot up suddenly, but equally they could collapse overnight too. Regardless of how strong the fundamentals of a company might be, all companies are still exposed to factors and events in the market beyond their control, and there is always a possibility that the share price might collapse or the company goes into bankruptcy. Therefore, as long-term investors, always diversify our portfolio. Invest in index funds, or maybe index funds plus a basket of individual shares if you need some excitement in your investment journey. Always avoid an all-in approach into one single individual shares. While we focus on the upside, focus on 10x, focus on to the moon, we should also spare some thoughts on the downside. What if the share encounters a 90% collapse? Financially, can we afford the loss? Emotionally, will we be able to accept the loss even if financially we might be able to afford it? While I recommend a diversified portfolio, I fully recognize that compared to an all-in approach, this is boring and there is not much excitement. However, maybe long-term investment is meant to be such. Do our research, educate ourselves, set up our investment portfolio, review it maybe once every 2-3 months, and in the meantime, focus on our career while waiting for our investment to grow in value over the long term. The third guiding principle that I would like to share is have a realistic target investment return. Very often, I hear these young YouTubers sharing their very strong focus on 5x, 10x, on retiring on one sniper share going to the moon by 2030. Before too many viewers are carried away with these ideas, I would like to share another perspective. We should always bear in mind that shares with the potential to 10x will likewise has the potential for a wipeout. While I concede that there are certainly shares with the possibility of growing 10 times in value, likewise, these same shares will have the possibility of seeing a 90% drop in their share price. And when that scenario plays out, Financially, can we afford it? Emotionally, can we accept it? And let's not underestimate the emotional stress on us when our investment has dropped 90%. Can we continue to sleep well? Will there be a loss of peace? And is it then all still worth it? I'll leave you with this additional point to consider. Temasek, GIC, headed by a few ministers with a team of highly paid million-dollar fund managers. Do they attain 5x, 10x every 8 to 10 years? And if they can't, what makes us think that we can? In summary, as long-term investors, let's invest only what is truly our spare cash. Adopt a diversified portfolio. Invest in index funds, maybe index funds plus. And finally, be realistic in our target investment return. Be happy with maybe 6-8% return over the long term, over 10, 15, 20 years. That helps us to protect against inflation, plus maybe a small returns to reward us for taking on the investment risks. I hope you have found this content useful. However, I fully appreciate that for a topic of this nature, there will be differing views. I invite you to share your views in the comments section and let's learn from each other.